So let's work through problems 1 through 5 in 10.9 Problem Mastery. So our aero motorcycle problem, we've got the information here, the expenses, depreciation, taxes, all this information. So let's get started. What are the cash flows at time zero? What are the initial cash flows associated with this project? Well, we have this from the problem. We have an investment of $20 million. And then we have an opportunity cost of $2.6 million. Where's this coming from? Well, if we do this project, we forego the opportunity to sell this land at its market value of $2.6 million. So that is an opportunity cost. And then we have a working capital investment. So anytime we start a new project, we're going to need some additional working capital. And the definitions you recall of working capital is current assets less the current liability. So what do we have to invest in inventories and accounts receivable, and how much of that is offset by free financing from our vendors in the form of accounts payable? So we're told that our inventories that we have to invest in are $3.5 million. We need to invest $1.5 million in accounts receivable, and that's offset by our $2 million that we're receiving in free financing from our vendors, our accounts payable, for a total working capital investment at time zero of $3 million. So we add the investment cost, the opportunity cost, and the investment in working capital, and that gives us total initial cash flow here of $25,600,000. And notice that these signs are negative. That's to denote that these are negative cash flows. These are investments that the firm has to make. Moving on to the operating cash flows. In period 1, we have our revenues. We're told here in the problem the revenues are $8 million. Our costs, our operating expenses, are 50% of those revenues. So 50% of $8 million is $4 million. And then our operating income, or earnings before interest, taxes, depreciation, is simply revenues less the cost, for a total of $4 million. So 8 million minus 4 million equals $4 million. And then we next need to calculate our depreciation. Depreciation, we're using straight line, and we're deducting the salvage value of the project from this depreciation charge. So what is the salvage value of this project? Well, the salvage value of the total, including the land, is $4.5 million. But we know that $2 million is the book value of the land. So $4.5 million less the $2 million, that is the salvage value of the project above and beyond the land. So the original $20 million that we invested, what's the salvage value of that? We can sell that at the end of the 10 years for $2.5 million. So that is what we're going to use for our calculation of depreciation. So the total $20 million less the salvage value of $2.5 million, that's $17.5 million, divided by 10, that gives us an annual depreciation charge of $1.75 million. That we can calculate our EBIT then. Simply EBITDA minus depreciation gives us an EBIT of $2.25 million. And then we can calculate the tax. Our tax rate's 35%, so 35% of the $2.25 million gives us this tax here. And taking the EBIT less the tax, that gives us our NOPAT, or net operating profit after tax. So $2.25 million less that $787,500 in taxes. That gives us a NOPAT of $1.462 million. And then to calculate the operating cash flow, because nobody actually writes a check right to Mr. and Mrs. Depreciation, we're going to add that depreciation charge of $1.75 million back to arrive at our operating cash flow for the first year. Now, because our revenues and costs are the same for each year, and because we don't have any additional investments in working capital throughout the life of the project, and because we're using straight line depreciation, the operating cash flows are the same for all the years. So for years 1 through 10, these operating cash flows are exactly the same, $3,212,500. And then we have these cash flows that occur in the terminal year. And there are three cash flows that we have, two in addition to the operating cash flow. We have the after-tax salvage value and our initial investment in working capital, where we're going to not continue to invest in working capital, so we'll get that $3 million back in year 10 at the end of the project that we invested at the beginning of the project. So we just need to take a look at what is the after-tax salvage value. Now, the total salvage value is $4.5 million, as we discussed before, but $2 million of that is land. So the salvage value of the project by itself is $2.5 million. Now, because if we look at the book value of this factory, that is simply the $20 million that we originally had less the accumulated depreciation. So we had 10 years of $1.75 million per year in depreciation. So $20 million less that $17.5 million, that gives us a book value for this factory on our books of $2.5 million. Well, the book value of the factory is $2.5 million. The book value of the land, so the book value of the total project there is $4.5 million, which means that our taxable gain is exactly zero. Right? If we don't have a taxable gain, then we don't pay any taxes. So the after-tax salvage value in this case is exactly the same as the salvage value of the project itself. So we add the operating cash flow, the after-tax salvage value, and our working capital to arrive at a total terminal year cash flow in year 10 of $10,712,000. Now, we can use the NPV function in Excel, and you're going to be doing that in the spreadsheet assignment, not for this particular problem, but you'll be doing that. So let's take a look instead of how would we solve this in our financial calculator. Well, our initial cash flow, as we saw before, was $25,600,000. That's a negative because it's an investment. The first set of unique cash flows we have are the operating cash flows of $3,212,500, and that happens 9 times. Now, we actually have that operating cash flow of $3,212,500 actually does occur 10 times. It occurs each of the 10 years. Then in that 10th year, we have the operating cash flow plus the after-tax salvage value plus that working capital that we're getting back for a total unique cash flow C02 of $10,712,500. Again, the C02 doesn't denote that it happened in the second year, simply that it's the second unique series of cash flows. And I didn't put that here, but F02 would be 1. And then we push the NPV button, plug in our interest rate of 10%, we down arrow to the NPV, hit compute, and again, your numbers are going to be different from mine because everybody gets a unique set of values for the market value of the land. So everyone's NPV is going to be a little bit different. Again, sorry for the confusion about the straight line depreciation early on in our discussion the other night, our Q&A session. I hope this clears things up.